Hello, good people. How are you? Super excited about this conversation. I'm always feel energized when I have to chat with entrepreneurs, business owners, just because one, it's a journey that I went through, still going through. But I think there's also some creativity and excitement that comes with creating something, building something, and then also sharing common struggles that we face as entrepreneurs. So I'm going to share my screen. We're going to go over the agenda in terms of what to expect. Really, I want us to be able, I want the attendees from this call to be able to live with something tangible, something that you can be able to use to power your business. And I also want to share my story as well, because as an entrepreneur, I've struggled accessing financing. And I think over time, I figured out the nuggets of how do you become credit worthy, how do you access capital, affordable capital to be able to build a sustainable business. So I'm going to be sharing all that throughout this presentation. And we're going to leave about 10 to 15 minutes at the end for Q&A. So save any questions that you have, happy to answer. And if we don't address them in this conversation, also happy to book one-on-ones with business owners who want to be able to learn more about what we share today. So let me go ahead and share my screen. Awesome. Can you guys see my screen? Yep. Awesome. So with regards to today's agenda, so we're going to just, I know Justina has briefly done some introductions, and then just going to add more just in terms of like who I am, what I do, the journey so far. And secondly, we're going to dive into the challenges of small business financing, what factors really affect access to financing, especially affordable financing options that allow you as a business owner to build something sustainable and that can grow over time. The third one, we're going to look at affordable financing options. So there are different financing options all the way from grants to loans to investments. So we're going to talk all about the different financing options. And then we're also going to talk about how do you build a strategy. So I'm going to share a strategy that I've used personally that has really been helpful. And I hope I can be able to simplify it so that other people can be able to use it for their businesses. And then at the end, we're also going to just speak about Woveo. I think we just surprise of like how we're empowering small business to be able to achieve their dreams. And then at the end, we're going to get into a Q&A. So really, the plan is to have the presentation, 30 minutes. We'll also have like two business owners who are going to also share their story for another 10 minutes. And then that will give us around 10 to 15 minutes for Q&A. Awesome. So yeah, Justina mentioned a bit about me. So my name is Jonah Chininga. I was actually born in Zambia, raised in Zimbabwe. Been in Canada for 10 years, and as an entrepreneur, I've been an entrepreneur for the past 6 years. This is my third business. The first two, it was lessons learned, and then this one, I think we're just using those experiences and insights to be able to build something that is more mission-driven and something that is really aligned with my passion. In terms of financing, raised over $4 million of capital. That's between venture capital and a very limited on the loan side, but I think it was also helpful at the early stage. And I'm going to also share how we're able to do that without any revenue. I'm a member of the Canadian Lenders Association, which is the ecosystem that focuses on all the financiers within the Canadian, all the way from consumers to small business. And then we're going to also certified by the World Bank under the alternative financing. Recent winner in 2022 were the Calgary FinTech Award winners at Woveo, and then that's kind of like what inspired the move, because we started in PEI before moving to Calgary, and I did my bachelor's at University of Prince Edward Island, which was an exciting experience for me, going to the smallest province. But I think there were a lot of like insights and experiences that really shaped me to be who I am today. And in the presentation, I do have a few videos because I really want to be able to separate between opinions and facts. So we're going to have I think about 3 videos in the presentation that are really going to either highlight the problem from a national perspective, because I think from a macro perspective, I think in Canada, we're also facing an economic downturn, which is really affecting small business owners. We're also going to discuss, share a story from an entrepreneurial experience, like what does access to financing mean? What is the impact of credit on a small business as you're running it day to day? And then lastly, we're just going to highlight some of the things that we have on the Woveo side to be able to power small business. So on the next slide, I'm going to share, I think it's a video from the president of BDC. So for those who are not familiar with BDC, it's the Business Development Bank of Canada, really sharing the current state of small businesses in Canada. It's a 2-minute video, but I think it's very informative and it's going to really explain the current problem that we have and then how as an ecosystem we need to empower small business to be able to achieve success. Okay, let me just jump into this.
We all see the headlines: poor productivity, sliding GDP growth, and fewer people wanting to become entrepreneurs. OECD research shows commercial financing to Canadian companies grew by 165% since 2011. However, the percentage of new loans going to SMEs decreased from 16% to 8.6%. Canada's entrepreneurs have fewer and fewer options for financing compared to their G7 peers. Everyone has an opinion on how to fix it, but not many are actually doing something about it. So I believe it starts with unleashing the untapped economic potential of our smallest businesses. We see opportunities in regions and sectors that are underserved and groups that are underrepresented. BDC's own research shows at least 300,000 entrepreneurs are underfinanced. That's nearly 1/3 of Canada's 920,000 active small businesses. We believe working with partners could allow us to reach 100,000 more entrepreneurs over the next 10 years. To put that number into perspective, all of us working together will boost the number of small businesses in Canada by 10%. That's a real impact. This is about taking collaboration to the next level so that no entrepreneur is left behind. Having more productive businesses is one of the best answers to Canada's economic challenges. We simply cannot afford to let any untapped potential go to waste. Working with our 80 partners, we will redefine what it means to be bankable.
Awesome. So I shared this video to be able to highlight that if you're an entrepreneur, if you're a small business owner, if you're having challenges with raising financing for your business, you're not alone. I think this is a systemic problem in Canada, whereby entrepreneurs are not being supported to the best of our capacity to enable growth, to enable employment, and to enable people to build sustainable and high growth potential businesses. And I think when you look at it from our nation perspective, we have 920,000 active small businesses. And out of those 920,000, 300,000 small businesses are underfinanced. Some of us are on this call. Most of this business are business that we interact with on a day-to-day basis. And if a business is underfinanced, it's not able to be able to operate at its full potential, and it's not able to be able to utilize the talent and the skill and the know-how that they have to be able to compete, whether it's locally or internationally, when they don't have the right resources. And then just to also highlight that I think it also relates to my personal story with founding Woveo, with my co-founders, as well as the team in general. So for us, how we started, it was mainly like from a grassroots level all the way to mainstream. But I think this story is really important. So when we started as entrepreneurs, one of our reality was we're immigrants. Two, we were still temporary residents at that time. So no bank would work with us to be able to finance our business. And one of the things that we did to be able to build a foundation for our business was actually use the system of community savings. Some people can call it rotating savings, group savings. Traditionally, some people know them as susus, ajo, Chalmers. They have different names globally, but I think it's something that whereby a group of people come together. So with founders and then our friends, we're able to come together and pool money together. And I think the first $10,000 into the business, we did that. And what that enabled us to be able to do was incorporate the business, conduct market research on the opportunity that we're looking at, and then also build an MVP. So that was the first phase of the business. And I think that took us about 18 months just to be able to give a picture of what that journey looked like. After that 18 months, we went into the next phase of the business. I think having more research, having the business incorporated, and then having some form of a product that we could sell on the market. It wasn't fully fledged. It wasn't up to par of what we wanted to be, but it was something that we show that it's in the market, and we can be able to show that as proof to financiers. We're able to secure the next 25 from CBDC to be able to finance our business. And mainly the use of funds in this stage was mainly go to market, and then as well as part-time hires, because no one was getting paid in the business. We're all working for free, but we needed to be able to start building some traction by committing more time and having more people who are crucial to the work that we're doing. And then in the last phase, which was growth, we got to this phase probably after 2 years. That's when we were able to raise venture capital to be able to now build and accelerate our growth as a startup, mainly to be able to build a robust technology, and then also our commercialization as a business. So that's kind of like the journey, just highlighting the struggles as a small business when you don't have anything to prove what you can do, and then what it can actually take, and then the tools that you can be able to use to replicate something like this from going from grassroots to mainstream, using kind of like an approach that we had to go through. But then if we had now to look at like why are small businesses underfinanced, I think it boils down to three things, right? If you look at like why is my small business not getting access to capital, from a banking perspective, from an investor perspective, it boils down to three things. The first one is collateral requirements. And this is a big factor that affects low income to middle income entrepreneurs. You don't have any generational wealth behind you. You are probably new to the country. You're probably a young person who just graduated college. So you don't have much. You don't either have assets that you can be able to use as collateral. And then secondly, you also don't have a good credit score, which is typically 720 and above, to be able to get access to financing. And I think the bad thing about this whole situation is your first loan as a business owner is based on you, the individual, not so much your business plan. Your business plan is more of a supporting document, but it's not the basis of your access to financing. So that's the first piece. The second piece, which I also think really doesn't make sense within the ecosystem, is business history, right? From a personal perspective, we talk about credit history, financial history, but typically for banks and other financial institutions to be able to work with you, they want you to be in business for 3 to 5 years before they can fund you, right? For them, it's a way of risk mitigation. But what happens within the first 1 to 3 years when you need that capital to be able to actually build your business, build your product, and finance your business? So that's a gap that's within the Canadian market. And then the last one, I think, which is very, very important, is the high interest rates. And then typically what you see is you see business owners now going towards very expensive financial products to be able to build their business. But when you look at it as a business, on average, small businesses in Canada have margins between 7 to 10%. If you have a very good business, it's between 10 to 20%. But then if you're borrowing money above 20% APR, then the margins that you're making really don't make sense to be able to build a business. And by the time that you now have built that business history, you really don't have an advantage, because the foundation of the capital that you use to be able to fund your business has really affected where you can be able to get your business to the next stage. Some business owners sometimes can be able to like, oh, hey, let me just use my credit card. But then as a business, you know that your cash flow is not guaranteed. So if you miss that payment, you're now getting charged 22% interest rate. So those are some of the things that are creating challenges in terms of how entrepreneurs can be able to gain access to sustainable capital to be able to build sustainable business. On the next slide, I'm going to share a story from an entrepreneur who was willing to be able to share kind of like what access to capital means, but then also the impact of those high interest fees as a small business, especially coming from underserved communities, especially coming from like low income communities where you don't have the right access to those financial tools that others are taking advantage of. So a bit about him, it's Mike from Sport. He has one of the, I think that's my favorite restaurant to go to in Toronto. I really love their jollof rice. It's based in Scarborough, and then they have multiple locations, and he's been in business for a long time. And then in this video, he shares kind of like the impact just from a personal experience of like how access to capital and then how interest rates impact his business. So it's just going to be a 30-second video just to be able to highlight what that means.
When it's like high interest, the profit margin is very slim. So then you need to have to make double or triple the sales in order to meet the demand that I have.
that you
Now,
have.
if I get a loan that has little to no interest, what happens now? I can buy bulk and I can get a better price. What I like to do is because I'm thinking about my customer, I'm thinking about long-term customers, I can pass that discount on to my customers. When it's like
So I think this is just a quick highlight of like as a business owner, if you're paying high interest fees just based on the debt that you've collected, how that can impact the amount of sales that you have to do to be able to service that debt. And then this is the reality because in Canada, millions of people have low credit scores, and then also our banking system just doesn't support financing businesses. They're more risk averse, and then they're not really supporting the ecosystem to be able to provide access to affordable financing. So your only options end up being like limited to only alternative lenders who charge high interest fees or other financial products that you can be able to use. And on this, I want to be able to simplify because I think this slide tells the picture of the current ecosystem in Canada. So this is kind of like the new reality. Looking for mid from 2023 from 2024 going into 2025. So this slide talks about the new regulations that the government just recently implemented in Canada. From a financial perspective, lenders, the maximum interest rate that they were charging before was 47%, but then now it has been reduced to 35%. And this is efforts from the government trying to address affordability, which is a big crisis in Canada right now. But I think there's another option of cutting off most people who are considered high-risk borrowers or they have low credit scores from actually the mainstream financial ecosystem and pushing them to pay their lenders. So this article from Financial Post, I think it really highlights on like what the new rate can be able to impact small business owners in terms of accessing credit. Because now, because of the reduced APR cap, if we are high risk, then the alternative lenders don't want to be able to work with you. So your options are even getting smaller and smaller. And to be able to highlight that, so this is from TransUnion. It shows the range of credit scores in the Canadian economy, right? And it's been my reality, it's been my experience. And then also for me, it was also my personal reality that most entrepreneurs, it's our reality that sometimes we have bad credit scores because you're running a business. Sometimes you need to apply for a loan, your credit report is dinged. Sometimes your cash flow doesn't come on time because you're waiting for someone to be able to pay you, so you're late on your phone bill. So, right, creating that correlation between credit scores and actually building a business, really those things don't connect. And then that's the reality of most small business that myself have been through, and then most small business that I meet, that's their reality. Like that credit score system, someone might have a viable business that's generating enough revenue, that's doing really well, but then just because of that piece, it's now really affecting everything. In Canada, for example, out of the 29 million people, you can say 30 million people who are within the credit market, typically above the ages of 18 and above, 8 million Canadians have credit scores under 20, right? And then these are people, so when you look at it from a good credit score and a bad credit score, this is the separation, 720 being the good, and then 720 and below being the bad. And then on this slide, on this last graph that I'm highlighting here, it shows the correlation between interest rates that you're charged and your credit score. So for example, in Canada, 8 million people have credit scores below 720. And most of these individuals are immigrants, coming from low-income communities, underserved communities, are young people who really don't have much assets or much financial history to be able to leverage. Almost 5 million of them, when they have to borrow money, they're paying 35% plus in interest fees. So they're using the likes of like, if you think of like Easy Financial, First Stone, all those other alternatives which charge very, very high rates. And then now what happens is when that 35% is what you used to be charged, let's say 35 to 47, and that is cut down, then as a small business owner was probably using that credit to be able to support your business, you are no longer having access to it. So this is the critical issue that's happening within the Canadian ecosystem right now of like, how can we be able to reduce the risk of those borrowers that we consider to be high risk while maintaining access to credit and not cutting them from the mainstream ecosystem, because it doesn't make sense for a small business to end up going to payday lenders who are not regulated, but then they can charge you up to 300% because they're paying about 25% every 2 weeks. So that's the current ecosystem that as a small business owner, and then your low credit scores, what are my options? What can I be able to use to be able to fund my business? And then this can create that mismatch in terms of like business viability, as well as the capital that you're using in terms of like your business. So that's from a problem perspective, just highlighting the current ecosystem in Canada. Looking at the financing options. So now I want to be able to create a picture between the challenges and then the financing options that are available. So in terms of the affordable financing challenges, broken down to two, they're non-dilutive financing. So non-dilutive just means someone gives you money and in return, they don't ask for ownership, right? So it could be a grant, it could be a loan, it could be cooperative savings that some people use to be able to fund their business. That doesn't take ownership in your business. That's just more financing for a period of time. Some of them you can repay, some of them you don't have to repay. And then on the dilutive financing options, there are angel investors. You can find someone who wants to be able to give you a certain amount of capital, and then in exchange, you can be able to give them ownership or shares into your business. And then others is venture capital, which is really not as accessible as you would want. But I think if we were to break down the financing options for majority of small businesses, it will be into this. For me, I'm a big believer that you never build a business strategy on grants, because a grant, the reality is, out of all the applications that go in, less than 5% get access to that financing. So it's really, really hard to be able to build a business strategy to like, okay, I'm going to use this grant to fund my business. That's the reality of it. And then also, secondly, you want a grant if it comes into your business, it's a bonus, right? Or I was planning to be able, in terms of my roadmap, I was planning to be able to do this in May, in Q. Now I can be able to do this now because I've added this grant. So really, grants are something that is not really part of a business strategy when you're starting off, but a bonus and something that is an important tool that you can be able to use to build your business. I think my favorite grants that I've taken advantage of, but I think most small business don't really apply for or even engage, because I think in every business there's a unique aspect of that business, and it's the National Research Council. The National Research Council of Canada, IRAP, usually funds all the way from like $20,000 up to $1 million and then up to $10 million for bigger projects, right? So starting a business is a research that you need to do. I think that's one I wanted to highlight just in terms of grants. And then also at the end of this presentation, I'll do share a database of financing from grants and loans that small businesses can be able to leverage through that Excel sheet. The second one is loans. And in loans, one thing I want to really highlight is credit unions. I think as a small business, credit union are potentially are like your best friend, because I think from a credit union perspective, they are more flexible when it comes to access to capital. They are more location based. So whether it's in your district, your city, because most people don't just have access to a bank to be able to give you a small business loan. That's the reality for most small business. And I think credit unions have the advantage of, if you're able to qualify for a loan, the rates and then the repayment terms are much more flexible to be able to support your business growth. But then still, not everyone can be able to leverage those systems. But one thing as a small business owner, I really encourage is opening a bank account with a credit union to be able to build that relationship. Because I think credit unions, let's say 6 months you're banking with them, they're seeing your cash flow. There's an element that they can be able to support your business as it grows and as it builds more history. And they're more friendly to small businesses, depending on where you live. And then the last one is rotating savings. This is a mechanism that some people use informally, as we've used as well. I see this as an option that entrepreneurs can be able to use, especially when you're pre-revenue, right? For us, when we're pre-revenue, we also didn't want to take the risk of getting a loan. Sometimes business fails, so we didn't want to now end up like in debt because the business has failed when it was too early. I think the risk is better to take off when you start generating revenue. Now you can be able to apply for a loan. So this is something I always recommend businesses to be able to use. I'm starting a business. I need initial capital to be able to do incorporation, to be able to, if I'm selling or if I'm a barber, to get a location, to pay my first 6 months rent, to buy the equipment. I need $5,000 to be able to do that. And then you can be able to use mechanisms like that with like-minded owners and putting capital together. So this is an option because one, it's interest-free, and then two, it's something that is more community-driven that you can be able to put people together and leverage that form of capital to fund your business. On the dilutive options, the angel investors and venture capital, but really not going to speak much into those options. But if any entrepreneur on the call is interested, happy to share how you can be able to tap into the networks of angel investors, and then how also you're able to leverage venture capital to be able to grow your business if you feel that's the right fit. Moving on into how do you build a strategy to become credit worthy, to become bankable. I think there are a few things that we need to really understand just in terms of the relationship between capital and risk. I think once you're able to nail down on this relationship, you can be able to see, one, what's the best capital for your business, and then how do you position yourself for success. So I think the first piece that's really important is doing a needs assessment. What type of business am I building, and what's the cash flow of the business? Is it more of a high growth? Is it more of like a business that's going to need more capital injection of research and development before it starts generating revenue? Is it more of a business that generates revenue from day one? What's my credit score? There are different factors that you need to be able to assess, as well as the use of funds, right? Are you looking to buy equipment? Are you looking to be able to buy a property? What is the use of funds that you need to be able to align with that needs assessment? The second thing is exploring your available financing options. So what you come up as being like available options, you have to narrow it down to what you can potentially qualify for. I think creating that match can actually help you not to waste your time, because some businesses end up 6 months into financing when you could actually be building your business. So I think that's something that you need to be able to do in terms of what are the options, and then what's my situation, and then how can I be able to match the two. The last piece is the common knowledge, building a business plan and financial documents. But around building a business plan, I think there's a different approach that as a small business that you can be able to take. And I'm going to share a little bit more on that on the next slide. And then around the strategy, I think two things that I really wanted to share, something that I've used, something that has worked for us at Woveo, is one, whenever you're applying, whether it's a loan or even a grant or even an investment, take advantage of alternative data that you have on yourself or on your business. So for example, let's say you're applying for a loan at a credit union. Your credit score might be low because, one, you're new to the country or you've missed a bill, but then there's so much data that can show that you are a responsible borrower, such as your rent payments, right? I can take my rent payments, and you don't even need to wait for your rent payments to go to Equifax. You can be able to add it as part of your documentation that that you're adding to the application. Sometimes you might be in business, and you can add, like, as a business, you're renting a property that you're paying month-over-month rent. It shows that the business is able to service those obligations. Add as much alternative data, even if the bank is not asking for it, even if the credit union is not asking for it, to be able to support your case. Because most of the times the whole situation is just not based on a credit score. And I think there's so much data about us that we're not leveraging to be able to fund our business. Some people they're in partnership, but then they don't even put the name of their partner on that business, or they don't even put the name of like who they're working with in terms of like partnerships, or in terms of a co-founder, in terms of like who is supporting your business. Add as much information to be able to de-risk your business, because that's what financiers are looking for. That's the first part. And then the second strategy is called the onion theory of risk. So I want to make sure that I simplify this as much as possible. So the onion theory of risk, it's a risk strategy for when raising capital as a small business. And then how you look at it is you look at a business as an onion. So an onion, it has different layers, right, on it. And then your strategy is, because every financier, whether they're an investor, whether they're the government or a lender, all they're seeing is risk, right? You're coming in like, oh yeah, starting early. They know that the business failure rate is about 50%, 90% over 3 years. They know all that statistic. So what you really want to do is like look at your business as layers of risk. So like as an onion, it's layers of risk. And then how do you prioritize which risk to take care of first? And then how do you build a business plan to be able to showcase to that financier how I'm going to be de-risking the business over time, starting from now and then moving forward. And the perfect example I'm going to give as a playbook. So I used what is it called? The ChatGPT Sora to be able to create this onion, just show how you peel off layers. I hope it was helpful to just explain the theory. But then, like, let's say, for example, there are three key things that you need in this strategy. One is knowing the risk associated with your business. Every business is different. The risk factors are different. But knowing like the key risks that are associated with your business is the first place that someone knows that you know the business and you know the industry that you're operating in. The second one is, what are the strategies that I can be able to use to eliminate each of those risks that are involved in my application, in my business plan, in whatever the case might be. And then the last one is, what financing milestones do I want to be able to reach? So sometimes you might want to raise 500,000 to start your business, but you don't need that 500,000 all up at once. You can say like, okay, in year one, I'm starting now. I don't have much information on my bid. I just need $10,000 to get from point A to point B. But then in your plan, you're putting like, in my plan, I want to raise 500,000 over 5 years. You have to put it up front so that someone can be able to follow that journey. Because as business owners, one thing that happens is most of the information is in our heads. And if we don't know how to communicate it, if we don't know how to tell that story, tell that vision, then someone else is not going to get it, because you're working with an external partner, you're working with an external financier who don't have all the knowledge. So how can you be able to lay it down in a strategic manner to show where you're going? So for example, let's look at any type of business, whether it's a barbershop, a restaurant. The key risks, the most common risks that are associated with the business: operational risk, market risk, financial risk, cash flow risk, liability, right? Those are kind of like some of the common factors. And then in the first year, whenever you're starting a business, the biggest one is operational risk. Do you have the skill set to be able to actually execute what you're going to say that you can be able to do? So in my plan, what I'll say is like, okay, this operational risk, I can be able to address it, because me as the founder, if it's a barbershop, I can actually cut hair, right? I have the skill to be able to demonstrate that I can actually be able to do that. So that's one point, right? You're using your skills that you have to be able to start a business in an industry that you're aligned, and then someone can be able to connect the two to be able to de-risk. That's one risk factor that has been taken out. So having a skilled team, whether it's you or whether it's the early partners, employees that you're working with, highlighting that in the ability of the skill sets to be able to execute that. The second one is around market risk. What's the potential of this business, right? So sometimes you can use market research, but then concrete information just in terms of like bootstrapping and getting on the ground to be able to highlight something. I think most people focus on the number of customers, which early stage is not the most important number. I think the most important for me, from my experience, is the retention of those customers, because it's harder to keep on getting new customers than it is to be able to retain those customers that you have. Because if you can grow 5% month over month and you're retaining everyone that you're keeping, it shows that there's potential for growth, because you're able to retain those customers that you're working with. So even if you have 5 customers, are they coming back every 2 weeks to be able to get a service from you? Are they coming back in your restaurant to be able to eat every once a week? Right, that retention, that's something that you should be able to measure, more importantly than just the number of traffic that's coming to you. I think that's a really, really important factor to be able to factor in your application, how you position yourself. Next one is financial risk. Financial risk is part of like many business, whether you're starting or whether you're 4 years down the line. And financial risk is associated with, is this business going to be sustainable over the long run? And one of the best ways to do it is having multiple revenue streams, because some businesses, they're seasonal. Businesses have peak periods as well as down periods. So having multiple revenue stream, and this is something that you don't expect to have all in year one, but then making it part of your plan, like, hey, we're starting with this revenue stream. If it's a barbershop, for example, we're starting with like making money from the service that we provide to our clients. Secondly, in 6 months, or in year 2, once we raise the additional capital, we're going to start selling our branded products. We're going to start doing this. So adding multiple revenue streams can actually enhance your business viability. The fourth one is cash flow risk, right? Cash flow risk is different from financial risk, because I have seen a lot of business whereby their business is generating a lot of revenue, but then the time that your people who owe you or people who are waiting to pay your invoice, that gap can actually kill a business, right? Let's say like every month your business is generating $10,000, but now you have people who are not paying you on time, but then you now have an obligation to be able to pay $10,000 to your employees, because if you don't pay your employees, they're going to leave. The service of the business is going to drop drastically. So that's something that you want to be able to keep on top of your mind. And I think one strategy that you can be able to address that is having a good relationship with your financier, right? Or having a line of credit that's always available for your business, if that's the case. But in some cases, if that's not available to you, it's just maintaining a good relationship. Like, okay, hey, when I'm building my business, I want this organization, I want this company to be my financier growing long term. How do I build a relationship? Whether it's starting with just a bank account, whether it's starting with this, but how do you build that relationship earlier on so that when you need that capital, it's available to you? Because you can be expecting 100,000 in June, but then you have a need for 50,000 today, which you don't have. But then the money is all in your accounts receivables. So like that's something that you're not able to use, and that can really drastically affect your business. So maintaining those good relationship or having options to be able to service that, I think it's a key element. And then the last one is liability, which typically you want to be able to service with insurance once you can afford it, but then just having something that you can be able to show your defensibility as a business. So I think these are factors that you can be able to line up in a 5-year business plan, in a 5-year financial projections, aligning with the financing milestones that you want to be able to reach. I want to build a business, a barbershop that can actually have 5 locations in Toronto in 5 years. And then this is the plan that I'm going to do it. Okay, I'm going to start by renting. And then once I get this X amount of dollars, I can pay at least 3 months rent before I start getting to a point where I'm breaking even. And then just kind of like aligning those things and then addressing the risk factors from the top priority. I think prioritization is the key thing about this whole strategy. Knowing that when someone looks at your business plan, when someone looks at your business, what are the top risks that's going to come to mind first, and then addressing that as a key. I think it just shows you know more about the business. It also de-risk the business in terms of the capital that you want to be able to achieve. Because one thing that we have to remember about capital is people charge high interest rates if they consider that the risk is very high. So always your objective is to be able to reduce the risk as much as you can to be able to gain access to affordable credit with that. So that's the strategy. I'm going to share this presentation if someone wants to be able to replicate it. If someone wants to go more in depth of how you can be able to turn this into a business plan, also happy to do that. But then up next, I just really want to use the next 5 minutes, just because we've explained the problems, the challenges, and then for us at Woveo, we wanted to be part of the solution. We started as a community financing platform, mainly enabling people to be able to use their own savings as a way to be able to create forms of credit for their communities, for their other businesses to power themselves. And then at this next level of growth, super excited to be announcing a $10 million credit facility that we're going to be launching to support small business in our community, in underserved communities, all the way throughout Canada. And then this is something that myself as a business owner, I've struggled with. I relate to the problem. I know the challenges of matching your personal finances and your business financing, and then just trying to be able to prove yourself. Because as a business owner, at the end of the day, you're always trying to prove yourself, whether you're trying to sell to a customer, whether you're trying to gain access to financing, is how can I get someone to believe in me so that I can have that ripple effect to be able to grow my business. Our main objective with this is for us, we want to be able to work with micro and small businesses to make them bankable. So our vision is to be able to come that one partner that someone can be able to come to us, and then we can be able to work with them, finance them in their first phase of growth, and then pass them to our key partners that we work with. And part of our mission is actually providing access to affordable capital, because we know what it takes to be able to build a business. It doesn't make sense to be able to charge someone 20% interest rate when their margins are that, right? We're not supporting each other in that relationship. So I think for us as a mission, we want to be able to maintain our interest rates between 8 to 10%, but then in the worst case scenario, 18% is the highest that we can charge. And we're aligning that as a tagline because it's the highest that credit unions can charge as part of like providing access to affordable capital. That's one thing that is a core pillar that we want the community to hold us accountable to, but then provide as a way to provide access to capital. But then that also means that for us as a business, we have to take the right measures to be able to make sure that we're increasing access, but whilst reducing the risk on that capital that we are deploying within the communities. Our key objectives is to support, so $10 million, our main objective is to use that in 2025. That's kind of like our starting process, because we have a vision of getting to $1 billion that's going to be deployed in underserved communities, supporting thousands of small businesses in underserved communities across Canada. Starting this year, actually, we started like the pilot in January. We're already funding businesses. The second one is increase access to funding through a community-driven model. And I'm going to explain what that community-driven model actually means and then how it works. And then our main objective is to lower the borrowing costs and make the repayment terms as much flexible as possible. I think the sad reality about our ecosystem, especially when it comes to credit, is those who earn low income have to pay the most. And I think that just creates the cycle of that wealth inequality that always seen, like businesses are not succeeding because the cost of capital is higher when you are low income, when you are kind of like don't have everything. So how do you be able to bridge that gap? By providing access to that opportunity that a business owner can be able to get something sustainable so that at least they can be able to survive long term. And then how it works for us, we're mainly looking at 3 key things, always open to feedback, but then our call it our credit box, but our main requirements, because we're starting with loans of up to $10,000, and then once we generate more information, more data, we're going to increase it to 25,000. But we want to be the first relationship partner to small businesses to enable them to be able to grow. Our key requirements: you have to be in business for at least 3 months, and we measure that by either incorporation documents of the business registration, whether it's a partnership or a sole proprietorship. That's one thing that we use. The second one is 3 months of recurring revenue. So $3,000 is kind of like our best minimum, because we want to be able to support people who have the capacity. So that's kind of like one of the things that we want to be able to do. And if, for example, you're a business owner, you're just starting, you don't have any revenue, we also help you through our rotating savings ecosystem, that we can be able to match you or help you to be able to gain that access through that community saving. And then once you build that initial traction, give you the loan that can support your business growth over the long haul. And then the last piece is the accountability partner. This is where it gets interesting, because with accountability partners, it's something that for us, we have seen that it works in terms of driving better credit behaviors. So how it works is whenever you're getting a loan, you should come with an accountability partner. And then this accountability partner is someone that can help us reduce the risk. From our community financing that we've done over the years, we've facilitated over $3 million in transactions, and our repayment was above 98% repayment. And then that's one mechanism that we want to be able to transfer into the credit system, so that we can enable people to access affordable credit, but then using that accountability is the same way that we behave better if you're going to the gym with someone who's holding you accountable. It's just human psychology and human behaviors that we want to be able to implement into the credit system. And the responsibilities of an accountability partner is mainly helping you with that credit behavior development, but then also as an accountability partner, we share the revenue with them. So let's say, for example, you get a loan of $10,000, the interest rate, let's say, is 10%. So you're going to pay over the loan life cycle, it's $1,000. We give them anywhere between 1% to 3% that we can be able to give them to incentivize you for helping you through that whole process. But then secondly, we also just launched our Woveo credit score, which are going to be continuously developing. That can also help you build the Woveo credit score, that we can help you as a business transfer you to our other referral partners to be able to gain access to capital. So let's say you work with Woveo, you get your first $10,000. Now you need 50. Now you need 100,000. We have partners that we can be able to share your data with your consent as part of the Woveo credit score to help you gain access to affordable credit as you build your business. So I know we have 15 minutes left. For us, with this program around supporting small business, our vision is to be able to deploy and empower small business with $1 billion in capital by 2030. And this is something that we are holding ourselves accountable to. We are also working with different partners from financial institutions to help us with that capital, but then mainly focusing on how do we drive impactful metrics in terms of like the communities that need this capital the most, but then making sure that we're paying a key focus on affordability to make sure that we're giving people a chance in a way that is sustainable and helps them to be able to build better businesses over time. So we're starting with 10, gradually growing into 50 million. 2027, our target is 100 million. And then by 2030, we want to be able to deploy close to $500 million to support small businesses to be able to achieve their vision. And then this is something that we've been through. We've been doing this for now. 2025 is our 4th year. And then we've seen that this is a mechanism that can work. How can we be able to reduce credit risk to help small business to gain access to affordable financing, and then provide them a pathway whereby they can be able to build something that is sustainable? So from that, I'm going to invite Mike and Jennifer, who are just going to quickly share their stories. And then from there, I'm also going to just share the links at the end, just in terms of like, one, where you can go to be able to access funding resources. So we created a database of grants and loans that you can be able to access if Woveo is not the right solution for you. And then the second one is, if you're interested in the Woveo loan, we just created a Google form, which is the expression of interest. That's something that you can be able to scan as well to be able to also apply, and then we can be able to put you in the pipeline as well. That's pretty much it. Justina, I don't know if we have Mike or Jennifer.
I know we have Mike on the call, so I'll pass it over to Mike for a couple of minutes.
Hello.
Hey, Mike, can you hear us?
Yes, I can hear you. Yeah.
Amazing. Now I'll pass it over to you. So for context, everyone, Mike is one of the businesses that we've been working with for a while, supporting his restaurant in Suya Spot in Scarborough, and also a recipient of some of our funding. So he'll share a little bit about what his experience has been and the likes of that. Over to you, Mike.
Okay, how's everybody? Everybody doing okay? It's good. Anyways, yeah. So, in a nutshell, my experience has been pretty good from the very beginning. I mean, with every new product that's introduced, it takes time. It's like a learning curve, and I think it takes time for people to grasp this new way of getting funding. I mean, I've been in business for many, many years now. I mean, I started off with a shoestring budget, essentially, which I was funding the business myself. I worked for about 3, 4 years overseas, came back with a little bit of money, and I invested in all that money essentially into my restaurant. And the first 3, 4 years was a nightmare. I mean, when you have no credit, you have no type of experience on how to handle, I guess, the money that's coming in versus, making sure you save money for the future purchases. That was the biggest challenge for me. I didn't go to school for any of this stuff, so I was just kind of winging it, so to speak. But the first few years were very, very interesting and difficult, but I persevered. And then eventually, when my credit did get better, I was able to get financing, but it was still those high interest loans and those high interest, kind of like those loan sharks. And for me, I looked at it like this: it's better than nothing, because with those high interest loans, I was able to leverage them and essentially use it to build up my own personal credit, which brought my score up. Then I was able to apply for business credit and whatnot, right? So, anyways, cut out. Let's fast forward to like this last year when I actually was introduced to Woveo and the concept of community funding, being able to connect with, I guess on a smaller company. Essentially, it made it a lot easier for me to get funding. The experience was pretty smooth. A few hiccups here and there, but it being a beta, in beta form, I guess, you will expect that, right? But yeah, so I got approved for my loan. I was able to utilize it to make some purchases for my business, and I'm paying it back, and it's great. I've never been able to get a loan like this as easy as it was with Woveo. Yeah, so yeah.
Thank you so much, Mike. I will appreciate that very much. I will pass it over to Jennifer. Jennifer is still on the call as well.
Yep, I'm here. So my name is Jennifer. I started a nursing staffing agency along with my partner, Kalina. We are both two nurses in our 30s. We were working as staff nurses at hospitals, basically working paycheck to paycheck, not getting very far in life. So we decided to start this agency, and the first thing was getting capital, and that was difficult because both of us didn't come from that healthy background credit wise, and trying to break into the banks and talk to people there, they kind of just look at you like, okay, this is just a black girl that wants a credit card, or oh, this is just a business that isn't going to go anywhere. So they didn't really take us seriously. So we reached out to Woveo to assist us, to at least try to get our feet off the ground, like, and running. The process was smooth. It was pretty straightforward. I worked with, sorry. Yeah, sorry. It was pretty straightforward. Everything in regards to filling out the forms and doing all the paperwork, it was easy. I didn't feel like I was being hassled. I didn't feel like I was being pressured into anything. Everything was explained to me great. Um, and getting the loan was pretty simple. Since then, I've been able to grow my business. James has been great in regards to following up, seeing how I'm doing, checking in. It didn't feel like a bank and client relationship. It felt more like a family relationship because it felt like they cared. So I appreciated that from Movio, and hopefully I look to keep expanding with them in the future as well.
Thank you, Jennifer. Thank you. I'll pass it over to John. I know he's sharing some links in the chat as well.
Yeah, no, definitely not. I think thank you, Mike and Jennifer, for sharing your stories. I think it's something that just in terms of the challenges is relatable, and I think that's kind of like why we decided to take this path for us because we feel like Canada can only grow if we support the entrepreneurs. So I'm just going to quickly share the screen so that anyone wants to scan that link can be able to do that, but then also at the same time taking any questions. Yeah.
Absolutely. Jonah, just to add a couple of things, some of the links are also added in the chat. There'll be a follow-up email with, because I see that question in the chat as well, there'll be a follow-up email with the presentation Jonah has shared. It will be available for you to rewatch at your leisure on YouTube, and all the other resources, including the funding database that we've put together for you guys, will be added there. But questions wise, any folks have any questions, feel free to raise your hands, but I'll start with what's in the chat right now. So COB Technologies, Jonah asks, do you think the shift in DEI will perpetuate barriers in acquiring finance for BIPOC businesses?
No, that's an interesting question. I think definitely there's a shift. But like for me, one thing that I see is when it comes to capital, we operate in the like let's say a capitalistic society. I think when it comes to capital, capital will always go to where it's appreciated. So I think capital is always going to be available. Probably some form of funding will be disrupted. Like let's say grants, for example. I think grants will be very limited going forward just due to the change in the tone, the policies, and then how everything is working. But I do believe, just in terms of how, I think the more important question is how do we accelerate our growth and then our business viability to be able to build that infrastructure. And then also just to be able to share a highlight, I think back in 2020, 2021, I think there were almost like around $2 billion that was allocated to underserved communities. But then 5 years later, which was the timeline, only 20% of that capital has been utilized. So we need to be able to build the infrastructure from ground up, from like the financing mechanisms that allow people within underserved communities to actually take part in the distribution of that capital. I think that's going to be really, really important. And then the second piece is how do we build capacity within ourselves and not wait for people to be able to give us handouts. I think that's kind of like the mentality that I'm just taking to this. How do we enable us to be able to get to that point whereby we are building and then getting ready for access to that capital that we need to be able to build our business? So that's the approach, but I think some funding sources will be definitely affected.
Thank you for that, Jonah. Yeah, Obi says it's reassuring. Is there any other questions from folks? I don't see any more questions in the chat unless I missed something. But also feel free to like raise your hand or just come off mute and ask questions and interact as we near the end. Well, I did have a question while everyone is getting the questions together. Jonah, you mentioned grants not being a sustainable way of not being a sustainable financing model, in short. But when we think of nonprofit and very social impact focused businesses, what's some advice you would give to making themselves sustainable outside of grants? How do they create revenue models that still aligns with their social impact mandate and their nonprofit status?
Yeah, no, I think in terms of like nonprofits, probably like right now, I think there's a big fear within the nonprofit sector just around like with the whole change in the environment, how are they going to keep themselves sustainable? But I think you have to approach a nonprofit the same way a business would. Like, how can we diversify our revenue streams? I think like one thing is government always changes. It goes liberal to conservative, liberal and conservative. So building a strategy that's basing on those changes in government is going to be really hard to be around for years, decades, or centuries if that's the vision. So I always see it like one, how do you build relationship within the private sector? I think that would be my biggest advice, because sometimes the business model can not only be about selling something. Sometimes you can build relationships within the private sector that you have high net worth individuals who can be able to support the vision. So yeah, my advice would be in two ways: diversify your revenue streams and then build relationships with the private sector so you're not only reliable to the public sector.
That's great advice. Thank you. Do we have any more questions? We've done really well on time today, by the way. So love it. Well, while folks are still coming up with their questions as well, there's a couple of items I wanted to share, including an announcement. Folks on this call, you guys are the first to hear and the first to have access to this. We're actually launching, we're calling it Bridging the Gap for African Entrepreneurs program, and it's set to launch in the next couple of days. And this is going to be an accelerator cohort-based program where 12 businesses from Ontario will be selected to participate in capacity building, given up to $5,000 in capital, and the capital is coming from Woveo, so it will be in form of a loan, but it will be low interest with only 5% and repayable over a period of 12 months. And you'll get connection to a lot of industry partners like Okra Academy, African Impact Initiative, and many more. Lots of networking events as well. So you're the first to hear of it, and you can apply for this opportunity at the link that I've just added in the chat. So that is one. And then also, just because the conversation around grants has come up so much today, and I know as businesses very early on, debt is one form of financing, yes, but a lot of us might be a little bit risk averse, and we're looking for grants. And so on February 19th, we have a grant writing workshop that we're hosting. I'll put the link in the chat. Again, you're the first to have access to that. We'll have an expert, Jelisa Brown, who has done a lot of amazing work in social finance, and she'll be sharing, because she sat on committees and boards of what do you call them, evaluating committees, the committees that actually decide who gets the grant. So she has an understanding of what makes for a great grant, what makes for a great grant proposal, budgets, etc. And she'll also be sharing where to look for these grants based on your business needs and your business type. So this link is also added to the chat. Go ahead and register, and it will also be shared in the post-event resources. And we would hope to see you again on the 19th. And I'll pause for any last-minute questions.
Yeah, no, I think there's one question in the chat. There's a last question from James. Some of us have side hustles and we're looking to diversify our income. What advice might you have in terms of transitioning from side hustle to main hustle? I think for me, the biggest thing is I became an entrepreneur because I was underemployed. That was my reality. So for most people in Canada, just based on the state of our economy, most people are underemployed. So I think if you have a skill that you can be able to leverage to create an infrastructure that can support many people, I think that can go from being a side to a main hustle. One part about entrepreneurship that we always have to mention is entrepreneurship is always about taking the risk. I remember I was working as a banker in a casino, and then I just got to a point in time whereby I was just tired. I just quit. I didn't know what the next part would look like for me. But then two things that I had is, one, the ability to be able to take risk, and then also I'm fortunate enough that I came from an entrepreneurial family. So those skills are something that you can be able to learn, just in terms of at the end of the day, it's all going to be okay. I think there are way harder things in life than entrepreneurship. Entrepreneurship is hard, but I think there's always going to be better outcomes at the end of the road whenever you take risk. And then that's kind of been my reality. When you take bigger risk, how can you be able to leverage that? And then the second one, I think, is also just looking at trends. Really highly recommend, if you're technical, looking at the AI trend. I think that's a big one. And then also two, in Canada, we have a big problem with entrepreneurship. So if you're a skilled entrepreneur, I think there's a huge opportunity to work with the likes of BDC to support other entrepreneurs, because a surprising statistic, in Canada, we have 100,000 less entrepreneurs than we did in 2000. And then now our population is almost doubled to 40 million, but then the number of entrepreneurs is reduced by 100,000. So that's a big need. So I think that's a way you can be able to diversify the income, looking at what ways you can be able to do that. And then also, if you are into tariffs, anything about tariffs, a lot of businesses are concerned, especially if you're doing cross-border, you're working across North America. How are the new US tariffs going to affect Canada? I think there's a big opportunity in terms of how businesses are able to run logistics cross-border. Also, from an accounting perspective, if you have a skill from an accounting perspective, around compliance perspective, I think those are different opportunities that people can be able to leverage. Yeah.
Amazing, amazing. Thank you, Jonah. We are right at the hour. And so if we don't have any more questions, I'll have us wrap up right now. And as part of the follow-up resources, I'll also share Jonah's email. He's offered to do one-on-ones with anyone on this call. So if you want to pick his brain, talk more, because I know there might be more questions even on the VC side and how to build those, nurture those relationships, that will be added in the post-event resources. My email will be added, as well as James, who's our community success manager. And so if you have any questions you want to brainstorm